when you realize that India, China, Saudi Arabia appear to be publicly accumulating silver under the guise of industrial uses, it's a lot more than industrial. Silver is really more strategic than it is industrial. You mentioned billionaires. David Bateman is the one that comes to mind. He came out recently and said, you know, that just a 10% shift from gold to silver, where all the people investing in gold, if 10% moved it to silver, it would consume all newly mined silver globally. This is, you know, implying a potential massive squeeze. He said, you know, one billionaire won't do it, but 10 would. Or a 10% shift out of gold into silver. When you see governments like Saudi Arabia come into the fray, you know that it's coming. It's time for people to understand that we are at the later stages of this monetary system, and these lower rates will benefit the top 1% as asset prices will remain inflated. And I just think that you know, if you had higher rates, it would correct valuations. It would make it much easier for people, regular people, to afford.
Analysts expect it is only a matter of time before prices break above $40 and push to record highs, as the precious metal continues to attract significant attention. Some analysts have noted that if a central bank wanted to remonetize silver, it would buy the physical metal and not a paper derivative. On the bullion market, COMEX deliveries are an extraordinary anomaly. Governments like Saudi Arabia, China, Russia, and India are aggressively accumulating silver. Schectman states this is not for industrial use, it's strategic. The Saudi Central Bank recently bought into the iShares Silver Trust (SLV) ETF, backed by physical silver. This gives them indirect silver holdings. On August 14, 2025, a 13F filing revealed they acquired 932,000 shares worth $30.5 million. It's their first reported SLV investment. The idea of Federal Reserve independence is a total farce. According to world-leading analyst AndySchectman, this signals to the world that holding US dollars is the surest way to go broke, as the plan is to deliberately devalue the dollar, a policy they believe will accelerate de-dollarization. For decades, the US dollar has been the world's undisputed reserve currency, and US debt has been considered the safest asset globally. If the Fed becomes politicized, confidence in US debt could weaken. A small shift of capital from gold to silver could consume all the new supply, creating a massive squeeze. Schectman underscores that billionaires and endowments are already standing for physical delivery on COMEX. The scale of these delivery requests is particularly noteworthy. Each COMEX gold futures contract represents 100 troy ounces of gold. When thousands of these contracts stand for delivery in a single month, the metal value quickly reaches into the billions of dollars. A powerful contrarian indicator is flashing. Insiders are dumping stocks, with Warren Buffett hoarding cash and Jeff Bezos and Nvidia executives selling aggressively. Yet the public is all in, with record margin debt. Before we dive into AndySchectman's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Well, when you talk about Fed independence, it's really a lie. It's a farce because, you know, you got Stephen Mirren, who is the author of the Mar-a-Lago Accord. He's taking over supposedly for the position that's vacated. And now there's another Fed board member who is being investigated for mortgage fraud or something along those lines. Trump is calling for him to step down. You're going to see more people put into the Fed that will do the tidings of the current administration. There really is no independence right there. But what it really signals, I think, to the rest of the world is that holding dollars is very silly, that if you hold dollars, you'll end up going broke, because it's very clear. The Mar-a-Lago Accord and Stephen Mirren's plan is to devalue the dollar. I've been saying that on your dad's show for the last 2-3 months, that their whole plan is to devalue the dollar tremendously. So whether you call it independence or not, the folks that are being put on the board who will make the decisions, I believe, will make the decisions in line with what the administration wants. There is no independence. But this is all part and parcel for why you're seeing de-dollarization. Holding your assets in dollars is the surest way to go broke in an inflationary environment. The dollar's already down 11% so far this year. And this is a trend that I think will continue, not only just through de-dollarization, but also through the plans of this administration to have a weaker dollar with the intention of having it spur on manufacturing demand in this country, which is ultimately, I think, what they're saying they're trying to do. So yes, in an odd sort of way, it will enhance de-dollarization. And even though it appears outwardly that there is independence, the folks that are being put on the board are anything but independent thinkers. They will toe the line with the current administration. So it's just smoke and mirrors once again. Yeah, I mean, the deliveries on the COMEX are extraordinary, Elijah, as are the offtakes off the COMEX exchange, which are extraordinary. These are very, very much aberrations. They're anomalies. We don't see them very often, or never have until recently. And I remember talking with your dad in 2020 about all of a sudden all of these deliveries coming into COMEX. They've only increased 100-fold. But when you talk about trends, Saudi Arabia is now, to my mind, the third government next to China and Russia who are, or maybe let's call it the fourth, India. India, China, Russia, and Saudi Arabia now. And again, these are all, these are members, whether admitted or not. Saudi Arabia is, in essence, in my mind, pretty darn close to a BRICS member in that they are a full participant in the M-Bridge technology. They are going to all of the BRICS meetings. They are very much have one foot in and one foot out to appease the West, but by all of their moves appear that they are going lockstep with the BRICS movement. They took a major stake in SLV, the silver ETF recently, and enough to demand physical delivery. Now, they haven't done it yet, but you have to have a certain amount, like it's a basket, huge amount, millions and millions and millions of dollars worth in order to be able to demand physical delivery. This is a privilege retail investors do not have. They will. I find it interesting. We've talked at length about China flying around the world and buying doré and concentrate directly from the miners in South America and Mexico. We've talked about India buying over 800 million ounces in the last 5 years. We've talked about Russia making it part of their national stockpile, which we'd never heard before from a government. And now Saudi Arabia is doing just that. And so when you realize that India, China, Saudi Arabia appear to be publicly accumulating silver under the guise of industrial uses, it's a lot more than industrial. Silver is really more strategic than it is industrial. You mentioned billionaires. David Bateman is the one that comes to mind. He came out recently and said, that just a 10% shift from gold to silver, where all the people investing in gold, if 10% moved it to silver, it would consume all newly mined silver globally. This is, implying a potential massive squeeze. He said, one billionaire won't do it, but 10 would. Or a 10% shift out of gold into silver. When you see governments like Saudi Arabia come into the fray, you know that it's coming. I found it very interesting. One of the things that I talk about a lot when we talk about the public not holding any gold, very little. My standard phrase I copy from Rick Rule. He says, from Joe and Jane Sixpack to the Harvard Endowment Fund, the average of gold owned by the public and gold-related equities is 0.5%. Well, lo and behold, the Harvard Endowment Fund just bought $101.5 million in GLD recently. And so now you have all of these institutions jumping into accumulating precious metals. Now, these institutions, I don't know how much they understand the difference between GLD and the real thing, but you look at Bass, his last name is Bass, I forgot his, Kyle Bass, I think is his name. When he was running the hedge fund, I think it was for the Texas, the Texas Teachers Union, or it was a big fund for that. I believe that's what it was. It was a long time ago, maybe a decade ago, but he put all that money, like $1 billion into GLD, and they took possession of it as well. So I don't know if he intends to do this, or they intend to do this time, the Harvard Endowment Fund. But the very fact that they're buying $101.5 million in GLD tells you that gold and silver are becoming more mainstream, certainly more mainstream. And I think you'll see at this upper level on COMEX, sovereign wealth funds, endowments, that's one step away from the public, who is still kind of blissfully, whistling Dixie, not really understanding the significance of this. But the people who are very, very tied in to what's happening globally are making moves and standing for delivery. it's a big deal. To see the Harvard Endowment Fund jump into this degree is a very big deal. I've talked at length over the last few weeks about the contrarian indicator. And let's just go over it once again for the chance that the few people watching this haven't heard me say this ad nauseum. And I apologize for those who have. But on one hand, you have the insiders dumping stocks, the hedge funds, the managed money has been selling between 2 and 4 billion a week since June. Buffett is sitting on between 4 and 500 billion in cash. You have a 7-to-1 selling to insider buying since the beginning of the year. You have the 3 or 4 largest board members of NVIDIA, huge stockholders selling cumulatively over $1 billion in NVIDIA shares. You have Bezos has sold over $6 billion in Amazon since June 1st. You got all of these insiders who have the information selling, right? At the same time, you have the public, which is all in the highest allocation to precious or to equities ever, more so than the great financial crisis and the dot-com bubble, about 54%. But if that wasn't bad enough, they have the largest allocation to margin play, the highest ever, over $1 trillion, and the largest allocation to options. So options and margin signal speculation and leverage. So you have the public all in on leverage and margin. At the same time, the insiders are leaving. But flip it over to the other side. You have the public, as you mentioned, very tepid in terms of their understanding or allocation to the commodities. But what do you have going on the other side? You have the largest deliveries on COMEX that we've ever seen, ever. And the U.S. has become net importers. Who's bringing all of that gold in? And much of it leaving the exchanges. Well, those are the insiders who are closest to the information. So the insiders are buying commodities and selling equities, and the mom-pop public is nowhere near commodities and all in on equities. What could possibly go wrong? And this is what I think people should take away, is that, this is why the big money always wins. They're positioned when no one else has any inclination. And by the time the people figure it out, the insiders have been comfortably positioned for a long time, and they're probably at that point start looking for their next great value that no one else is noticing. And this is why the rich get richer and the poor get poorer, because the rich not only have the most money, they're closest to the information. They know the playbook. Do what they're doing, not what conventional wisdom is saying.
We are nowhere near the top. The general public hasn't yet entered the market. Instead, central banks and large financial institutions are quietly accumulating, with over 100 billion delivered from COMEX this year. Schectman says moves of that scale only happen when insiders know something is about to happen. While traditional assets are overvalued, hard assets are poised to perform. This isn't merely a temporary trend, but represents a fundamental reassessment of reserve asset management. Central banks from diverse economic regions are participating in this gold-buying surge, indicating a global consensus rather than isolated regional decisions. The World Gold Council reports that 2022 saw the highest level of annual central bank gold purchases in over 50 years, with the trend continuing strong into 2023. This sustained momentum suggests structural rather than cyclical motivations driving these acquisitions. Jerome Powell has abandoned the inflation fight, shifting focus to flawed data to justify rate cuts. This policy is likely to usher in stagflation, disproportionately benefiting the wealthy, as official statistics significantly understate the true inflation rate. The middle and lower classes will be hit the hardest. In a high-profile speech closely watched at the White House and on Wall Street, Powell said that there are risks of both rising unemployment and stubbornly higher inflation. Yet he suggested that hiring being sluggish could weaken the job market further. Let's get back to the interview.
We're nowhere near the top because the public has no understanding of exactly what is happening. This has been driven by central banks primarily, and big money, and whoever is taking possession here in the United States. But the public is nowhere near even entered into this at all. So no, I think that, to see a market move the way that it has without the public involved is rather telling. To see, what amounts to north of $100 billion delivered into the COMEX that we know of since the beginning of the year, What does that tell you? I mean, this has never happened before, and to see a lot of it leave the exchange, this has never happened before. And people at that level don't make moves like that unless they know something is coming. And I do believe that. I would say we're nowhere near the top. When you see, like, to your point, everybody talking about it, everyone having allocation to it, well, it may be time to start thinking about this. But not only that, we're looking at lower interest rates coming, which of course benefit asset prices. And so this locks out average people as far as I'm concerned, because the average people, they don't own assets, and assets are what make the wealthy wealthy. Because, you know, as they're going to choose a path of inflation, you're going to see everything pop up. You see stocks, real estate, bonds, gold, silver. All of these things are going to surge, in my opinion, at least at first. Now, what happens with the stock market ultimately is anyone's guess. To see all the people, all the big money moving out, to me, is very dangerous. But I think you will see cryptos, precious metals. Those things are going to do very, very, very well. Hard assets in particular will do very well, because these are things that will protect you as your dollar is losing purchasing power. And, you know, commodities right now are historically undervalued related to financial assets. So I would argue they're really the ones that are poised to break out. One of the things that I found very interesting coming out of that meeting, Elijah, is that Powell has more or less wave the white flag, if you will, against the battle, with the battle against inflation, and confirm that they will no longer aim for their silly inflation target of 2%. Shift away from these dovish policies tied to I guess you could say, trying to pretend that, you know, inflation is under control. It's not under control. And what they are looking forward to, or trying to do, is focus more on the labor numbers, which are ridiculous in and of themselves. When we saw, I don't know how many hundreds of thousands of jobs that were adjusted downward from May and June. And so in essence, it's a shift away from inflation expectations and now tying it directly to the labor market performance. I think what you can expect to see in that respect would be much higher inflation. And it's interesting that they're talking about lowering rates heading into what seems to be a very stagflationary environment, where unemployment seems to be increasing. The numbers which we were told that represented strong labor numbers were a farce. And inflation really is far worse than what they are saying, as far as I'm concerned. You know, you're talking, I don't know when the last time we've had a 2% monthly inflation number, and they'll never hit that target. So in essence, what you could expect would be much higher prices into a very weak economy. And, you know, they talk about, you know, this being a benefit for home prices as an example. Well, you know, lowering rates isn't going to benefit new home buyers. It's only going to make the problem worse. That's what got us into this problem to begin with. So, yeah, I think that the last thing really that this economy needs at this point, as far as I'm concerned, is lowering of interest rates, because it gets us right back into the same problem that we have been in all along, which is distortions of interest rates. The market should set the interest rate, not the bankers. And by allowing the bankers to do this, it's distorting asset prices. It's creating imbalances or misallocations between resource and capital. And this is the problem that we've seen over and over and over and over again, and that is not letting the market control the rate of interest and the cost of money, but thinking the bankers know best. They're late now at all, to me, is the wrong thing. This is the problem. We're boxed in, and they feel that they need to do this. But in essence, all we're going to do is distort things even worse. The rich are going to get richer as asset prices are going to go much higher. The economy is already slow. So for people who have already lost their job, or the lower income folks, are going to see much higher asset prices, or much higher prices in just the necessities that they need. So the wealthy get wealthier because they own assets, and the poor who don't own assets will find it harder to put food on the table, to drive to work, you're just going to see an uptick in inflation and an economy that is shedding jobs. The Bureau of Labor Statistics, the BLS, should just be called what it is, bullshit, BS. And the numbers that come out of there, whether it be unemployment or whether it be inflation, have misled the public for a very, very long time. And the numbers that they're telling us on inflation are actually much, much higher. You know this. Your dad knows this. We've talked about John Williams and Shadow Stats. He's been on your show, and he would tell us inflation's actually closer to 11%, not the 2.5%, almost 3%. The producer price index shot up last month, and again portraying higher and higher inflation. And really, this is going to light a fuse, if you will, under the costs of living expenses for the average American person. It's not going to do much to help the average American. What it will do is it'll benefit the upper 1% who have lots in the way of asset prices.
Despite market uncertainty, tariffs, and economic flux, silver is having a great 2025. With a nearly 30% surge this year, silver is not only proving its safe haven status, but also its industrial power. While the stock market is shaky, silver is shining, and the numbers don't lie. The precious metals market is experiencing unprecedented activity that few outside the industry have noticed. Deep within the trading data of the COMEX, a remarkable shift is underway as record deliveries of physical gold and silver reach historic levels. This development, largely overlooked by mainstream financial media, may signal significant changes brewing in the global financial system. If insiders are strategically positioning themselves in gold and silver, how much time is left before the broader market wakes up? And will there be enough physical metal available when they do? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.